Hey there, this is Pete Townsend from Norio Ventures, and welcome to Money Never Sleeps, a podcast that looks inside the head of entrepreneurs and at the crossover of startups, enterprise, finance, technology, and life as we know it. This episode of Money Never Sleeps is sponsored by PAT FinTech, the training partner that demystifies fintech and digital finance for financial services professionals. Owen Fitzgerald and I are back this week with another Money Talk segment. We chat through the absolutely you can't make this stuff up context of what's going on with GameStop and the WallStreetBets Reddit group, the context of the Plaid-Visa deal falling apart, and what's next for Monzo. We've also got an announcement on something new that I'm up to with early stage investing, so turn up the volume and listen in as we try to catch up with the world on this week's episode of Money Never Sleeps.
Money never sleeps, pal.
Here we go again. Cold open. It's not live from New York. It's not Saturday night. It's Tuesday night at 9:18 p.m.
It's Tuesday night live.
On the 26th of January, 2021. How you doing today, pal?
Pretty good. Yeah, busy. Lots going on. Lots of interesting stuff going on.
Loads.
It's always
Loads.
good. Always good.
The shift of activities in the last 3 months for me, at the very least, and I know you as well, has been just extremely interesting and getting repetitions, which is the biggest thing with all this stuff we're doing, right?
Yeah, that's it. It's all coming around eventually.
Yeah, like the
slow, but coming together.
You know, there's lots to say for Tiger Woods' 10,000 hours. You know, before you become an expert. Or something,
yeah.
Right.
Yeah, that's it. Actually, did you watch it? I haven't seen that Tiger Woods documentary on HBO.
No, I haven't watched it.
Haven't seen it.
I haven't watched it. I'm still trying to find a way to get HBO over here in Ireland. I don't have Sky Atlantic.
No,
a buddy of mine.
You need one of those VPN things. My wife has a thing that allows you to change your VPN in the house to like the US. Then I think you can get HBO on your one of the apps.
Yeah. I may give that a go because I'm missing Billions and I'm missing Succession.
I know, Billions I'm missing out. I would like to watch Succession.
Well, I had a big day today explaining Groundhog Day to my physiotherapist. So all's going well with rehabbing my foot. And
that's good.
The physio today, Resync Physiotherapy, for anybody living on the south side of Dublin, check them out. They're brilliant in case you get hurt with something, right? They'll bring you back to health. Anyway, I was explaining to him he wanted to book my next appointment for the 2nd of February, which is Groundhog Day. And joking, I said, I don't work on Groundhog Day. And he's like, what? Okay. So we started looking forward to the next couple of days. And he said, well, how about the 4th? I said, no, I was kidding. I do work on Groundhog Day. Don't you know what Groundhog Day is? He's like, no. I'm like, dude. So I explained it to him. Do you know how Groundhog Day works?
Do I?
Yeah.
Not particularly.
Okay, Punxsutawney Phil.
I assumed it was.
Punxsutawney Phil comes out of his burrow on the 2nd of February every year in the morning. There's a whole movie about this called Groundhog Day with Bill Murray.
Yeah. Bill Murray,
and if he sees his shadow, he gets scared and he goes back into his burrow, and it's 6 more weeks of winter. And if he doesn't see his shadow and he stays outside, that means we're going to have an early spring, right?
Okay,
so
nice.
Yeah, my physio, Dermot, hadn't heard of this yet. He's like, oh yeah, familiar with the movie, but I had never been aware of that. So we'll see what happens. But we're gonna have a long winter here in Ireland anyway, because we got 6 more weeks of lockdown, baby. So
yeah.
Anyway, so where we ended up today, right, with what we're covering tonight, is we had Matt McAllister on last week. I thought with Matt that we'd end up doing 2 episodes, but we just package it up into one with, even though it was just over an hour long and probably definitely our longest episode to date, I just wanted to leave it natively as the way it was meant to be with one conversation.
Yep.
So here we are. Let's just do a Money Talks tonight and look at a few stories out there that have happened in the last week or so that really caught our attention. And there is a big one that's happened in the last few days that actually has been brewing for a few months. This one is about GameStop, which are a video game console and physical game retailer, and a Reddit group called WallStreetBets. You want to do the honors, Eoin, and tell us what it's all about?
Yeah, well, we spoke about this a while back around Robinhood. In fact, I think it was the first newsletter that we put out was around this kind of, I suppose, retail traders. During COVID, have had nothing else to do, but they've had no gambling, no football to bet on in the US, so they've all been just trading stocks through Robinhood and a few of the other kind of online trading applications. But there's a subgroup, and I'm not massively familiar with how Reddit works, but there's a Reddit group, obviously WallStreetBets, they call themselves. There's over 1.8 million members. And they have just been taking the other side of trades against hedge funds and short positions on what are essentially not great businesses and driving up the price and absolutely hammering the hedge funds. And it's been hilarious to watch some of the kind of outrage for the poor hedge funds that are out there shorting the stock. And it's kind of come to a head this week with GameStop, which was kind of circling the drain as a business over the last couple of years. You know, my kids got a PlayStation for Christmas. We're able to download all the games through the console. I'd have no reason to go into a shop to buy a game. And they're obviously located in shopping centres, which nobody can go to. So, you know, they're really in a tough position, and a lot of the hedge funds have taken serious short positions on their stock. So it was up at about $40. They got a new investor on board back in August. And everyone kind of thought, well, that's going to turn the business around. But obviously the fundamentals are poor. So the short positions, it was as of Monday, 71 million shares were held in short positions. I think it closed today. What did you tell me it closed today at? 147.98, nearly $148, up 90% today. Because individual retail investors have just been buying the stock and not selling it. The short positions can't cover themselves, and I think it culminated in one of the hedge funds having to get bailed out by JP Morgan or Goldman Sachs or somebody.
Yep.
It's just a ridiculous story, but it does come back to what we talked about before, and I kind of thought it was fascinating because it could be one of those turning points, because I'm following it on Twitter, and even today there's been some serious big name investors have taken positions and bought GameStop over the last couple of days, you know, kind of just piling on the bad news for the hedge funds. Everyone thinks it's very funny. To me, like, part of it is just absolutely hilarious that this can happen. But I suppose the other question is could this be something that we look back on in 3 or 4 years' time and say, well, is this a turning point?
It's crazy.
You know,
it's absolutely crazy. And I think, you know, Dave Portnoy from Barstool Sports, you know, we talked about his contribution before to what's going on and using the power of the crowd to bring people into the markets. Right. And like you said, sports are back on, but it's a lot more fun when you're kind of there and you're betting at the same time as well. And it's hard to go to sports games these days. So it's something else to fuel the adrenaline to push things along. And it's just absolutely incredible that, you know, a group of nearly 2 million folks on Reddit have banded together with this Wall Street Bets subreddit. And have been driving the price. And like you said, I was just looking for that sound effect on my non-existent sound effect dashboard that goes, oh, when you said the poor hedge funds. You know, those folks were my clients for years. There are some wonderful altruistic hedge fund managers out there. And but at the same time, right, we know what it's like. We know the story. That being said, the business GameStop itself, right, it's been on a downward trajectory. Absolutely.
Yep.
They were going from $7.9 billion in revenue in 2017 to $8.5 billion the next year. To 8.2 is where they started coming down in 2019 to $6.2 billion last year. Now that's still a lot of money to bring in, but I think they got somewhere north of $450 million worth of losses. They're closing over 300 outlets. Or were closing last year, and they're closing them at a higher rate than they thought at the beginning of the pandemic.
Yeah.
In the beginning of the pandemic, they were down, around $2 per share. They went way, way, way down. And then, like you said, when Ryan Cohen came in August, he is from Chewy fame. He sold out to PetSmart for over $3 billion in 2017. So he's got a nice big chunk of change here. He was a big investor, did something with Apple, I think, a couple of years ago, but it was back 4 months ago. He filed with the SEC to say he had a greater than 10% stake in GameStop, right? So he took the seat on the board. A couple of his partners came in with him. People thought he was a savior of some kind, and that's what people thought might have started this run-up back 4 months ago. And someone actually put a big post onto the subreddit group with a 7-point treatise, really, on why GameStop actually might be able to turn things around, right? And where they're looking at the components of their business that were going to become digital, how physical games were actually preferred by the serious gamers over digital games, just to have something, whether it's collectible or whatever, but that you can resell, right, when you're done with it. New game consoles coming out and driving their revenues upward. So there was a few things that suggested perhaps they might be able to turn it around. But I don't think that's enough of a story to look at Ryan Cohen of Chewy fame coming in, turning the whole business around in a few months, and basically,
This is
going from 2 to 146.
No, it's funny because you can track it all the way back to the start of the pandemic, whereby, we had the Hertz thing where the price went up as soon as it announced bankruptcy. It was effectively the same group was driving that. You had the airlines, Davy Day Trader and the guys were all putting money into the airlines, driving up the prices, the movie theaters. It seems like there's this underlying thing of let's put money into the retail businesses, the stores, the things like that, whereby everyone else is saying that they're going to go down, and rightly so, probably for fundamentals they should, and they're just putting the money into that to screw the short positions ultimately. And it's this game of like financial chicken, I saw it described as earlier on Twitter, which is brilliant. But I suppose it raises the question then, because what does it mean? This isn't like the dot-com boom sort of thing and the crash there. These people seem like they're willing to continue to be active, and it's brought a large number of new kind of traders and investors into the market. So what does that mean for the kind of future of publicly listed companies when you potentially have groups like this who just on a whim can turn against you and drive the stock up or down?
I was thinking about that today. Okay. And again, having to do with crypto, as it is a lot of the time for me these days, and thinking about how the market dynamics change when your markets go to 24/7, right? Or when you're trading in a 24/7 market, and where you're responding to the news cycle. And where is that news coming from? What channels are you tracking? And I'm not saying CNBC and Fox News and CNN and ABC. I'm saying, subreddit groups, different parts of Glassdoor, when people talking about working experiences at different places, Yelp, TripAdvisor, all these different sites where you have all this market sentiment being tracked, right? Now, when you look at crypto, it's crypto Twitter, right? And that's driving, well, I'm not going to go out on a ledge and saying that's driving a lot of the activity and the Bitcoin volatility, but at the very least, it's an interesting channel to watch. Right. So I think you're getting at something really interesting here, Eoin, which is saying, are we getting to a point where these, not only is it just the news cycle, but it is the gathering of sentiment in a concentrated spot that is observable by those trading in the markets that we didn't have a few years ago? And is that changing how people trade? And is that changing how prices respond? Obviously, but it's a brand new world.
But it probably means that the hedge funds need to get smarter, because the crowd now potentially has the ability to move the price on their whim almost. Like I said, it's not necessarily tracking the fundamentals. It's just that they can decide, because like it's really evident with Tesla and their share price over the last kind of 12 months. Elon Musk is like, that subgroup is a massive fan of Elon Musk. He's like their unofficial leader sort of thing. So, even when Tesla split its stock, it still continued to go up, and it has gone up and up, despite it probably not tracking, from a fundamental point of view. It shouldn't necessarily be worth the value of all the other car companies combined, but it is. And that's partly because he has such a following and has that ability to kind of dictate where some of those trades are going and where that money is going. But what does that mean then for, the normal company? Because you could have situations whereby a group like that could turn against a business because of some negative news story. Maybe something from a climate point of view or whatever comes out about a company. If it gets the attention of someone like WallStreetBets, well, maybe they have the potential to really do some damage then. Mm-hmm. And that's a bigger kind of issue.
There's so much more to the story.
They had to suspend trading 9 times there on Monday. Did you see that on GameStop?
No, I didn't see that.
That's how much. That's how much was being traded, and how much shares were being traded in that period. That suspended 9 times.
I literally, I think it was crazy. I was seeing this morning that Chamath. I will just refer to him by his first name, and I will put his second name in the show notes.
The legend that is Chamath. Yeah,
he was out on Twitter this morning, I think, being goaded into doing something around buying in.
Yeah.
To GameStop, and he put up
115.
Yeah, he came in at 115.
He put out a tweet yesterday saying that he'd put $100,000 in somewhere for the best, suggestions, and it must have been GameStop, because he came back, responded to the tweet then to say he's gone into GameStop at 115.
Yeah, exactly.
Crazy.
So this is and the whole insider trading thing comes to mind, and being aware of what other people are trading and trading off the back of that. And it's like, it's not applicable here in this case. It's just completely different context. And, we're not talking about what Blue Horseshoe loves Endicott steel or anything like that from Wall Street.
Endicott steel, right? I love that. Yeah.
Yeah.
Joe, I was going to send you something earlier. I saw something that made me think of you because I saw people start to tweet, can I get paid now in GameStop instead of Bitcoin? And I thought you'd appreciate that.
Yeah, I would. I absolutely would. Yeah, I brokered another one of those deals just in the last few days, which has been interesting. But we are, I think we're in an all new world here. I keep saying that, and it feels like we're in an all new world every month. Just things are changing so fast. I love it. It's hard to keep up, but it's forever entertaining and also forever opportunistic at the same time.
We should ask Andrew Milani to come back on and talk about it.
That's exactly.
I know he was on one of our early episodes.
We had Andrew Milani from Premind on episode 57. Definitely a shout out to Andrew. And he's talking about medium term trading, which is the difference between day trading and then hold, buy and hold and do kind of your long term qualitative type trading. And where, the market is moving way too fast, even on a 30-day holding period, for a fund manager to keep up and make make accurate decisions based upon the news cycles. So he needs help. And he needs some automation around that, or she needs help and she needs some automation around that. So Premind comes along, able to provide all that. When we were talking to him, you talk about market sentiment out there on social media, think about things bouncing around on Twitter. You don't think about how you gather all this unstructured data, because Twitter is short enough with 160 characters, 140 characters, whatever, where you can kind of set some, programs to pick up on what's going on there. When it is Reddit groups, forget about it. I don't know how you do that in an automated way to pick up on this stuff, but you really have to expand your catchment net of what you're looking at here in order to trade these markets effectively. It's crazy.
Yeah. Robinhood used to put out daily information on where the bulk of their trading was being done, in what share or in what stocks, and they pulled that kind of feed that they used to provide to the market, because that you used to be able to get a good insight on kind of where the short-term day traders are putting all their money from Robinhood and their 13 million accounts or whatever, but they kind of pulled that feed and made it private again.
Gotcha.
It's an interesting one.
Yep. Speaking of pulling, we saw that Visa pulled the Plaid deal out from under Plaid's feet.
Well, I think it was the other way around.
Or was it the other way around?
It sounds like it was the other way around.
Exactly. And that just from a background perspective, the Department of Justice started investigating 12 months ago after the Visa and Plaid deal was announced, where Plaid was being acquired by Visa for $5.3 billion. And the investigation led to the DOJ saying, sorry, this is anti-competitive. You're basically taking competition off the streets by doing this deal. So sorry. Now, from a Plaid perspective, what I've been hearing, and it sounds like you've been hearing the same thing or reading the same thing because it's kind of out there, is that Plaid are pretty happy about this, given that, again, as we just said, the market's moving so fast, tech is moving so fast, revenue growth is on fire, especially in the digital world, that pulling the plug on this deal, pulling the rug on this deal is a good thing for Plaid because they're probably worth at least 30% more than what they were worth at least 12 months ago.
I would have said 2 or 3 times.
Yeah.
If you compare it to, and I don't have the exact number here in front of me, but the Affirm IPO and the numbers involved in that, I think Plaid is worth multiples of what it was at, and I think that's why they were happy enough. My understanding is, from what I've read, is that they instigated it kind of being cancelled because ultimately the valuation, aside from the DOJ piece, it was actually the valuation has moved far too. The whole thing has taken too long. Like Visa should have been able to try get in and close that deal as quick as possible. It's now multiples of that it's worth, I'd say.
Yeah, and people were saying, well, the Plaid founders left some money on the table, by walking away from this deal, and I'm like, they would have been leaving a lot more on the table by doing the deal.
Yeah, absolutely. But especially by the time it would get done. I mean, it could be another 6 or 12 months.
Yeah.
By the time the DOJ thing is finished.
It's interesting because the context is changing quickly. And I think it was Brian Brooks who's now former OCC, the Office of the Comptroller of the Currency. He's ex-Coinbase chief legal officer before he went into the OCC. And his parting shot, really, from the OCC, sent out a Twitter thread, it was last week, where he basically said, Europe has already figured out kind of banking infrastructure and doing it the right way with open banking. The U.S. has not yet. Why can't the U.S. just go in that direction? And, the view is that Plaid only really exists because in the U.S. market, banks are not mandated to provide APIs to third-party fintechs in order to enable those third-party fintechs to provide data to customers, right? Like we have with, they're called AISPs here. Shout out to David Heath from Circuit. He is the first AISP in Ireland, Alternative Information Service Provider under PSD2, that lets a third party, through a secure authorization process, gather your banking data, okay? And directly through your bank via an API connection. The way Plaid does it is it's still a password and username that you need to provide to your fintech app, that there is obviously that security, that privacy breach. It obviously perceived that way, definitely in Europe, and I'm sure there's some concerns about that in the US. But that's why Plaid has one of the first reasons they've done so well is because they've enabled all of these apps like Venmo, you name it, to connect to banks. Okay, but it's still, you got to give your password and username to someone else that is not your bank and is not you. So, in a roundabout way, I'm aware of players who have the option in Europe of using Plaid, using folks like TrueLayer, like Tink, Yapily, and they're using the other players. They're using the European players because they're plugged into the network here. Now, Plaid are so big and doing so well and have a lot more capital, a lot more money behind them. So I think they're going to figure it out. But if I were them, I'd be like, okay, great, we're doing really well in the US market. But outside of the US, especially in Europe, which is, the second biggest economic bloc, forget China for now. Jack Ma, let's leave him to deal with that, right? You're playing a little bit of a different game over here in Europe. So I'd like to see how they're going to figure that out.
The other thing that strikes me about it is what that means for Stripe, actually. So Visa, obviously, we're looking to get a good deal, a year and a half ago nearly at this stage. That value, I'd say, has gone up in multiples of now for Plaid. But it does kind of raise the question, who can acquire these companies? So let's say Plaid's worth double even now, 10 billion. So what are they going to do? Who can acquire them, especially if part of the reason that Visa were being challenged was that it was going to be anti-competitive. So if that potentially rules out, let's say Visa buying Plaid, it rules out the likes of a Visa or any of the big financial services companies from acquiring any of these players like a Plaid, like a Stripe. So Plaid will probably try to find some way now to either IPO or maybe through the legend that is Shamat, do an SPAC into the stock exchange.
The legend that is the SPAC.
The SPAC. But if they don't plan on doing that, and obviously Stripe have always talked about trying to stay private, where's the exit then for a company like that if you effectively now are too important or too big to be acquired by another bank? Who does that leave?
I don't know. I mean, it's like, the context of Plaid is that they built the brand new rails for digital finance, right? At least for fiat. And we'll see where they go with pure digital assets, which is another conversation. But Visa have all these old aging rails for analog finance, right? And between them and MasterCard controls so much of the volume, controls so much of the flow, that if Plaid were able to come along and actually start developing what they're doing to a much greater institutional scale, could they take on the old school rails? Yeah, I think they could. Yeah. And so, Visa acquiring them is kind of taking them, like I said, off the street. Is their exit an IPO? I think so, but I think they're probably going to have to bulk out a lot more. I mean, Stripe started out as an API, and now they're embedding financial services into small business apps, right? Into small business operational platforms and, financial and inventory platforms. So, I think Plaid have some, I'm sure they have a plan. I just, would like to see how they're going to compare vis-a-vis to the likes of Stripe and others moving ahead.
Because I think it's the piece, for me, it's the piece where these companies are kind of an infrastructure play. I think that makes them more difficult of an acquisition from a typical financial services company. So you mentioned TrueLayer. So the more of these companies that are there kind of building the infrastructure for other companies to sit on top of it, the harder it is then for an incumbent or whoever to acquire them, because it runs that risk, that competition risk.
It is, but I mean, MasterCard did one. Who did MasterCard bought? What was it? Finicity?
Yeah, Finicity, yeah.
But a smaller player, not as big as Plaid. So Anyway, space to watch, lots going on. The foundations of everyday money is shifting significantly. And like you said, are we going to look back on this period in 3 to 5 years' time and say, what was it that very interesting intersection of events? I heard someone describe it as a Cambrian explosion, right? I think that was Lex Sokolin in his long take newsletter that just came out today, the FinTech Blueprint, where he's talking about comparing, is this moment in time that we're going through right now with the pandemic, with the evolution and speed of adoption of smartphones, not only in developed economies, but in less developed economies, and the post-financial crisis angst really out in the world, all these things happening at the same time, is this going to significantly shift the landscape of how people live their life, how people spend money, how people, find their livelihood, perhaps. And they were comparing it, Lex was comparing it to period between 1760 and 1780, with a combination of different things going on around the world that led to the American Revolution, right? And it's never just one thing in isolation that happens. It's always a combination of events, like the Cambrian explosion itself, 540 million years ago, whenever it was, where it was the perfect geographical, geological, atmospheric, life-spawning period of the Earth, right? Going off on a tangent here. But I think we are going through one of those moments in its own very little humble way of how people spend money right now. Anyway. This episode of Money Never Sleeps is sponsored by PAT FinTech, demystifying fintech and digital finance for financial services professionals. PAT FinTech enable financial services professionals to transform their capabilities into the digital age, with dedicated virtual training programs geared towards those that can develop, deliver, and monitor optimally customized user experiences balanced by appropriate governance, control, and oversight. To learn more about PAT FinTech, go to moneyneversleeps.ie/PAT FinTech. So obviously, I know we've talked about before on this podcast about potential buyers out there from Monzo, and just thinking about where they are kind of on the competitive field right now with Revolut, with N26, some of the big US players like Chime and others. And you kind of look at Monzo and think they've done really well, but they feel like they're kind of a brand play. And how are you actually going to grow the business into being something that is a formidable financial player? And not just, as one analyst was referring to them in an article that I read, as charity for the UK market, right? Yeah. So considering the different industry segments out there, what do you think might be something to think about for a potential buyer from Monzo?
I think it's going to come from probably one of the less well-known tech companies. I don't think you're going to see them acquired by another bank. I don't think it makes sense. You may as well close them down then if you're going to try bring them in-house to a UK bank. Like they already, I don't think there's anything compelling enough about them that would have them bring them into a Barclays or someone like that and keep them as a standalone. I don't think it makes sense. And then are any of the bigger players going to acquire them? The Facebooks, Googles, any of those? I don't think I don't think it's compelling enough for them to acquire them and everything that comes with it. But you may see it, like we saw when we talked about it at that time with TikTok and Walmart and these likes, that it might be someone who's, next tier. Like Oracle were in the mix for that sort of deal. I think it might be someone trying to pick up a banking solution, banking offering as part of a wider reach. I mean, look, Visa have loads of money to throw around now. They're not buying Plaid, so maybe they'll go down that route.
Yeah, they might. But it's like, when you got such a big behemoth buying a small financial brand, you kill the brand.
Exactly.
Maybe some insights here, being aware of some of the folks that were on the original founding team of Monzo that had since left, and knowing their approach to, if you think about what Monzo were doing, there's something in the middle of their whole tech stack called an intelligent services layer, right? That is doing a lot more than just banking, right? It is going out in real time when you spend money to not Google, but do a search for, okay, where did you spend money? What type of retailer is that? What category am I going to put that into for your spending, right? That's all happening in real time. And, there's a lot of intelligence that's gone into that. Is this something that can be replicated, right? In a banking as a service type model, right? Because there's a number of players out there that are doing that now. And could you actually take these assets of the tech stack and actually turn that into something that is sellable on a repeatable basis, right? That's kind of what I'm thinking about this. And that just came to mind the last few minutes.
Genius. No, I think it makes a lot of sense. Like we've talked about this before, the idea of, because I see it now even in my Revolut account, they keep trying to tag things that I have as a subscription. Because obviously the more intelligent they can get around what I'm doing and how I'm spending my money, then the more they can offer me on the other side. The more that they can tie into that. So if Monzo could do that better already, well then that fits nicely into someone who needs that piece of it, more so than the customers or the card or the brand.
Yeah. I think they could end up with something quite interesting there. And it's the value of the relationships they have there, the value of the customer base. There's got to be something that you can do with that that's going to be compelling to somebody else who wants that kind of market. I'm thinking crypto.
Well, I was more actually, as you're talking it through, I'm more thinking someone on the financial management side, and maybe it's coming into the kind of wealth and or I wouldn't say fidelity, but those types of businesses where they already do the wealth management piece. So let's now come down the kind of food chain a bit and into the space where we understand how you spend your money, and here's how we can add products to it.
Big time. And I'm getting teed up to do a podcast with a group that's talking specifically about wealth and wealth management and fintech and wealth. And you really have to think about how people are spending money. What do they have left after they spend their money at the end of the month? Do people that spend all their money and not save any of it, are those the people you really want to bring into a wealth product? What is a wealth product? What does that really mean? I'm not attracted to a wealth product. I'm not wealthy, right? Can you call it something else? Can you call it a savings app? I don't want a savings account. I'm not going to make any money on that. I want crypto. I want to earn based upon staking my ETH to a network, right? Wonderful. But, anyway, I think there's a lot more psychology that goes into this. I think there is a wonderful user base there with Monzo. I think it's something that is going to end up in the right hands. And the fact that you and I are talking about this after Chris Skinner tweeting about it, other people must be talking about this, right? And I don't think we're jumping the gun at all here by suggesting that Monzo should be bought by somebody, because I do think it should.
Me too.
Anyway, I think we've hit the three key stories tonight. Definitely. With GameStop, with Plaid and Visa, and with Monzo. Riffing on Monzo, right? So I had one or two other things I wanted to mention. First off, rest in peace, Hammerin Hank Aaron. He, to me, is still the home run champion of the world. He hit 755 home runs in his career. He was surpassed by Barry Bonds back in the 2000s, but Barry Bonds was jacked up on juice to the extreme with the steroids that were coursing through his veins and his skull. So I kind of disqualify him, even though Major League Sports haven't yet disqualified him. But yes, rest in peace, Hank Aaron. I have his book, his autobiography, autographed up on the bookshelf in here with a baseball card that is autographed by him as well. I met him in 1991 at a charity event that my mom brought me to. So shout out to Mom for bringing me to that. Pulled it down the other day and took a picture of it after she forwarded me his obituary. So, and I know you mentioned as well that it's Kobe's anniversary today.
Yeah, sad day.
So Kobe Bryant, rest in peace as well. And speaking of Los Angeles, where Kobe Bryant played for a very, very long time, we had Brian McMahon on the show from Expert Dojo. Back, he was episode 109 and had a great chat with him. He's running an accelerator called Expert Dojo, which are also making some investments in early stage funds. And I'm pleased to announce that yours truly, I am now sourcing investments in early stage Irish startups, mostly Irish startups, because that's where I think the biggest gap is for pre-seed and seed stage funding. So I'm now sourcing investments for Expert Dojo. So opening up the deal flow now, going to make that a lot more public on LinkedIn. Obviously, sharing it on the podcast is a means of going public with this. But we want to start opening up that deal flow because there are a lot of opportunities, not only just in the usual places that people look in Ireland, but also in the Northwest, in the Southwest, in the West, out in Galway, in the Southeast, that may not always come out of the woodwork. And I think going to go find them. And then generally also with a network going to different parts of Europe and back to the US, I think there'll be some good opportunities.
That's a great deal for you. That's great. No better man to be leading that out.
Yeah, happy to have that outlet now, finally at this stage. So, anything else that you want to touch on before we wrap it up for the night?
No, actually, shout out to Sean O'Reilly in TU Dublin, or DIT as I still refer to it. They launched their postgrad diploma in fintech. It started, the induction was this week, so it starts tomorrow night, where yours truly is given a guest lecture, intro to fintech. It's great. There's loads of interesting fintech courses now happening in Ireland. Lots of really kind of well-delivered, well-run programs. This is another addition to that, and it's great to see. I think they had over 300 applications, possibly for 50 places, which is great. So yeah, keen to see what comes out of that. We might get Sean on at some point in the future to tell us how that's going. So that's it.
All right. Well, we'll leave it there tonight, bro.
Pleasure, as always.
That does it for this week, folks, and thanks to listening to us try to figure out why the world does what it does. Links and show notes for this episode are on moneyneversleeps.ie, so check us out online. Also, you can subscribe to our Money Never Sleeps newsletter at moneyneversleeps.substack.com. If you're enjoying Money Never Sleeps and want to see it continue, make sure you hop on over to Apple Podcasts and give us a 5-star review. Also, check us out on podchaser.com to tell us what you think, or leave us a voicemail on our website, moneyneversleeps.ie. And don't forget Conan Brophy from Create Sound. He mixes and edits each episode for us and is an excellent media man to get in touch with when you're thinking about launching your own podcast. As for me, I help startups get their products to market, get customers, and finance their vision. You can find me on LinkedIn, on Twitter, or at norioventures.com. You can follow Eoin Fitzgerald on Twitter at OwenFitzgerald9. Finally, till next time, thanks for listening. See ya!
Money never sleeps, pal.